Boom! What's going on, Investomaniacs? Your boy Nat Ratter here, and today we're going over every single company that is IPOing in June of 2019. We don't have too many this month. We've got Legend Biotech, Lantern Pharma, ZoomInfo Technologies, that is not related to Zoom Video, Warner Music Group, and Pliant Therapeutics. I don't know if that's how you say Pliant. I don't really care. I didn't look it up because I didn't want to invest in it. Anyway, up first, we've got Legend Biotech. This is a clinical stage biopharmaceutical company engaged in the discovery and development of novel cell therapies for oncology and other indications. This is not a biotech company I would be interested in, but I typically, as a generalization, I'm not a fan of biotech companies. I think, especially the early stage ones, I'm talking about, they typically just, I think there's way too much risk relative to the potential reward, and I think they require a lot of knowledge in that particular space, which I don't have. Revenue's up about 15%, but look at this. Research and development expenses went up like 140-ish% or something like that. So I don't like it when your top line's only going up 15%, but your research and development is going up. Actually, it's like over 150%. A lot of that. Same thing we're seeing for admin expenses. Selling and distribution expenses going way up. Look at that. I mean, just 50% of revenue we're seeing selling and distribution expenses. It's just insanely high. And if we just go all the way down to the bottom line, we saw a $2.8 million net loss in 2018 versus a $133 million net loss in 2019. So this is just too far away from profitability for something that I personally would be interested in. Up next, we have Lantern Pharmaceuticals, a clinical stage biotechnology company focused on leveraging artificial intelligence, machine learning, and genomic data to streamline the drug development process and to identify the patients that will benefit from our targeted oncology therapies. Well, apparently they haven't done much targeting yet because they have zero revenue, and that's not the type of company, again, that I personally like to invest in. Just don't like the risk reward there. So yeah, I mean, honestly, I kind of stop at zero revenue. You can look at the additional numbers if you want, but zero revenue, that's enough for me to take a pass. Up next, we have ZoomInfo. That's a leading go-to-market intelligence platform for sales and marketing teams. This is a space where there's a lot of money, but there's also a lot of competition, so you got to be careful. Let's see, top line revenue going from 144 to 293 million, going from 2018 to 2019. So that's roughly 100% increase on the top line, which is quite good. Gross profit going from 106 to 224, so that's over a 100% increase year over year. Again, very good. Operating expenses somewhat reasonable considering the growth, going from 80 to about 190. Income from operations going up about 50%, going from 27 to about 36. Now, here's where I become more concerned. Interest expense went from 58.2 million to 102.4 million. So that's very high interest expense. They're only bringing in 293 on the top line, and they're paying 102.4 in interest expenses alone. That's a lot of interest expenses that I just don't feel comfortable with. So that means, they're growing really, really fast, but they are requiring a lot of capital to grow that fast. And that makes the investment a lot more risky. So we can see our net loss. Let's just go ahead and go down to the bottom line net income, going a loss from about 29 million to a loss of 78 million. And, when you're bringing in 293 on the top line and you're losing 78, they're having over negative 25% margins. So that's just, again, that's too risky for my personal preferences. These are the types of companies that can explode up. They can go super well if things kind of work out, but they're quite risky investments. Additionally, just a little bit of extra info. So you see here, currently they have $143 million in about 144 million or 143 million shares rather, and they have they're selling off about 44.5 million shares. So that's about a third of the company they're trying to get $921 million for. So very roughly speaking, they're trying to value the company at about $3 billion. They have At least as of year-end 2019, $1.2 billion in debt, up from 633 million in end of 2018. So pretty much, the more or less, kind of like all that money that they're selling about a third of the company for is just going to paying debt. So yeah, you're going to initially be debt free, but remember, obviously they took on that money because they need so much capital to grow this particular company, or at least this particular management team needs a whole bunch of capital to grow, and I don't see that stopping. Right? I don't think they're going to be able to cut expenses that dramatically that quickly, where all of a sudden you're not going to see a significant amount of dilution in your shares. So that's what I'm concerned about. I love the top line, obviously. I'm just too concerned about the amount of capital they're needing to grow that company, and I would be concerned about future dilution or debt issues. Up next, we have Warner Music. We are one of the world's leading music entertainment companies. Now, I'm not really a fan of this industry. I wouldn't really want to invest in the music entertainment industry. There's been a lot of kind of disruption in previous years, and I think we're going to have future disruption as well. So it's just not an industry I really like all that much. And so even though a company as large as Warner, I figured they were going to be profitable, I figure it's not going to be that expensive. But again, it's just not an industry I feel comfortable with. So our revenues, this is the first, Q1 2020, they're roughly flat, pretty close. But obviously we do have Corona issues, so you can kind of, say let's get rid of that and let's just look at kind of 2019 versus 2018, where they went up roughly about, what is it, like, I don't know, 12.5%, something like that, 12%, which is not nothing. But again, that's not enough growth for what I personally look for. And even if I was comfortable with 12% growth, I want to be confident that I'm going to continue to see that 12% growth. And this is not an industry where I'm confident that I'm going to continue seeing that 12-ish% growth going forward. So again, I didn't really bother breaking down the PE for the, when they're offering the shares or whatnot. But if you're comfortable with a smaller, about a 10 to 12% growth, and you are more confident in the music industry, then you may want to look in terms of the PE and whatnot and kind of see how expensive it is for what they're offering. Up next and last, we have Pliant Therapeutics, if that's how you say that. We are a clinical stage biopharmaceutical company focused on discovering and developing novel therapies for the treatment of fibrosis. Here, we do have some solid revenue coming in, and we're actually profitable in Q1 2020. So this biopharma company is further along relative to the other ones. Again, I'm not a big fan. I don't really personally invest in biopharma companies, but if you did want to, this would be the biopharma company going public in June that I would look more into. You can see in 2018, we had no revenue, went up to 57 million in 2019. And Q1 2020, this is during the Corona, issues, about 29 million, which if you times that by 4, just to kind of annualize that, we're coming to roughly like 116 million. Well, look at this. All of 2019 was 57. We're already roughly doubling that just in Q1 of 2020. So if with no further growth in Q2 through 4, you're already going to see 100% top line growth. But I do expect you're going to continue to see further revenue growth in the remaining quarters. So the top line is doing absolutely fantastic. Research and development is growing, but not at an obscene amount, especially when you look at the Q1 2019 versus 2020. That's pretty beautiful right there, considering the top line difference. And then let's see here. So this is nice. The loss or income from operations, $31 million loss in 2018. Only a $1.2 million loss in 2019, and they actually turned profitable, making $11 million in Q1 of 2020. So this is definitely a company that I would be more interested in if you are a person who does invest in biopharmaceutical companies. I do just want to caution you, however, although things are getting much better, definitely, you are experiencing a decent amount of dilution during this time. So going from 2018 to 2019, you went from roughly 1.2 million to over 1.6 million shares. So that is, you're probably looking like, I don't know, 38% dilution there or something like that. And then going from Q4 2019 to Q1 2020, so just in this most recent single quarter, you went from over 1.6 million to just below 1.9 million. So you're probably looking at somewhere around like 18% dilution there. And I'm sorry, I was looking at, well, they're the same numbers. But that's a lot of dilution. Just, you want to keep that in track. Anyways, so I personally am not going to be putting any of my money in any of the IPOs for June 2020. But now you guys know what's coming up. Hope you guys have a great day.